It's time for another weekly wrap. This week we saw the expectations from last week met. If you haven't had a chance to watch last week's weekly wrap, I suggest you do it again, because I covered a very key concept, and it's a concept of momentum. If you remember, when I was talking about the upcoming week, I was talking about a resistance area up here, just below 97.40, that was about 100 pips or so, and then I was talking about a support area down here from 95.55 down to, really the 94.60 area. And the point that I was making was, because we can look at past trading and we can see that the market has had trouble in this upper area here, getting past it, penetrating through, and because we can see an area in here where the market has had trouble breaking past it, we can look at these two areas as prime signposts along the road to riches, if you will. And really, here's the way I look at it. If we are truly driving down the highway and we're looking for a potential exit, you have to realize that every time you see an exit, you are also going to see a signpost. And that signpost is going to tell you all the information that you need to make a decision to get off the freeway or not. And fortunately, in driving at least, there will usually be signposts above telling you what's coming down the road. So what we have to do as traders is to look for these same signposts. And we have to remember always to keep things as simple and as common sense as possible. When you see that a market has an area where it's been difficult for it to penetrate through, and specifically what I'm talking about is this V bottom here, this V top, and this V top, all indicate to me that the market has an area where it has been difficult to stay in. And really, it's a simple, common sense equation. Can the market consolidate above the resistance level, or can the market consolidate below the support level? And you can see in both of these cases that was practically impossible. Although I will say this, the market did consolidate a little, quite a bit longer down here than it even tried to up here. You can see that there was very little consolidation on either of these two spikes to the upside, but there was a bit of consolidation down here. Now, what do I mean by that? What I'm talking about is a retracement inside of the move. You can see here that the market was trading up, paused for one bar, and then immediately started coming down. The market was trading up, hesitated at resistance, spiked, and then started coming back down. Whereas on the bottom, you can see that the market spiked down, traded back up, and then made another retracement back to the downside. This type of setup indicates that there was additional selling interest down here. How do I know that they were selling? Well, price went down. Remember, supply and demand in the market is king. It rules. There's nothing else but supply and demand. All of the tools that we can put on our charts, trend lines, moving averages, MACDs, stochastics, ADX, DXIs, ultimate oscillators, whatever, you might do, the Holy Grail indicator, whatever you may put onto your chart is simply representing supply and demand. And what we're trying to do is gauge what is the strength of the supply or what is the strength of the demand.